In this video, we're going to be performing a deep dive on AT&T's dividend safety. To begin, let's talk about AT&T's business model. AT&T is a leading provider of communications and digital entertainment services in the United States and worldwide. The company provides internet access as well as television and wireless services to millions of consumers. AT&T trades on the New York Stock Exchange with a market capitalization of $233 billion. AT&T is one of the world's most popular high-yield dividend growth stocks. The company's current dividend yield is 6.2%. Moreover, AT&T is a consistent dividend grower. In fact, the company has increased its annual dividend payment for 34 consecutive years. This qualifies AT&T to be a member of the Dividend Aristocrats Index, a group of exclusive dividend stocks with 25 or more years of consecutive dividend increases. You can use the link in the top right of this video to download a free spreadsheet of all the stocks in the Dividend Aristocrats Index along with relevant financial metrics now. For the remainder of this video, we will discuss AT&T's dividend safety from three perspectives: its dividend safety in the context of its current earnings, its dividend safety in the context of its current free cash flow, and its dividend safety in the context of its current debt load. First, let's discuss AT&T's dividend safety in the context of the company's current earnings. Since the beginning of fiscal 2018, AT&T has been guiding for adjusted earnings per share of about $3.50 for the 12-month reporting period. When the company reported second quarter financial results on July 24th, it raised its guidance to the high end of this range. For context, AT&T currently pays a quarterly dividend of 50 cents per share, which is equivalent to an annual payout of $2 per share. This implies a dividend payout ratio of 57% if the company is capable of meeting its 2018 guidance for adjusted earnings per share. Using earnings, AT&T's dividend is very safe and we have no concerns with its sustainability moving forward. Many analysts believe that comparing a company's dividend payments to its free cash flow is a better method for assessing dividend safety. Accordingly, we will now compare AT&T's current dividend payment to its free cash flow. When AT&T reported second quarter financial results on July 24th, the company updated its free cash flow guidance. It now expects to generate free cash flow of approximately $21 billion in fiscal 2018. This guidance is inclusive of all costs associated with the Time Warner acquisition. To measure AT&T's dividend safety, we must compare its total dividend payments to its free cash flow. We can calculate the total amount that AT&T will pay in dividends in fiscal 2018 by multiplying its current share count by its annual dividend payment. During the second quarter, AT&T had 6.351 billion weighted average common shares outstanding. If we multiply this by the company's current annual dividend payment of $2 per share, we determine that AT&T should pay out about $12.7 billion of dividends each year unless its share count changes significantly. Using the free cash flow guidance that the company provided in its last earnings report, this results in a free cash flow dividend payout ratio of 60%. Using free cash flow, our conclusion for AT&T's dividend safety is the same as when we used earnings. We see no risk of a dividend cut in the near future. The last angle that we will use to assess AT&T's current dividend safety is by looking at the company's current debt level. AT&T's debt level is elevated right now due to the recent acquisition of Time Warner. Under the terms of the merger agreement, each share of publicly traded Time Warner stock was exchanged for $53.75 in cash, plus 1.437 shares of AT&T common stock. Total consideration was $79.1 billion. The cash portion of the transaction was funded primarily through debt issuance. So just how large is AT&T's current debt burden? The company wrote the following in its most recent quarterly filing with the Securities and Exchange Commission. We had $180.2 billion of total notes and debentures outstanding at June 30th, 2018, which included Euro, British Pound Sterling, Swiss franc, Brazilian real, Mexican peso, and Canadian dollar denominated debt that total approximately $36.1 billion. AT&T's business stability and creditworthiness means that the interest rate that it pays on its debt is rather reasonable. The company wrote the following in the same filing. Our weighted average interest rate of our entire long-term debt portfolio, including the impact of derivatives, was approximately 4.3% as of June 30th, 2018, and 4.4% as of December 31st, 2017. To determine the safety of AT&T's dividend in a rising interest rate environment, given the company's tremendous debt load, we can perform a stress test that measures the company's change in free cash flow for particular changes in its weighted average interest rate. The results of such a stress test are shown here. As you can see, AT&T's blended average interest rate would have to rise to approximately 9%, or more than twice its current level, for its free cash flow to fail to cover its dividend payments under its current business conditions. Key assumptions here include a constant level of debt for the company, the achievement of its 2018 free cash flow guidance, and no meaningful increases to its annual dividend payment. Despite these numerous assumptions, the wide margin of safety here leads us to believe that AT&T's current dividend payment is very safe indeed, despite the company's hefty debt load during a rising interest rate environment. Thank you for watching today's video, which performed a deep dive on AT&T's current dividend safety. We invite you to subscribe to this channel and like this video, which will help more people discover SureDividend's investor education efforts. If you're interested in learning more about our systematic approach to dividend growth investing, visit our website at www.suredividend.com.